Hey everyone, Coach Investor back to another video for today. So a huge week for the market and probably a huge week for your portfolio as well because big tech is reporting this week. If you want to know a bit more about that, Apple, they account for 7.1% of the S&P index weighting. And this week we have Microsoft, Google, Facebook, Amazon also reporting earnings this week. Together they make up well over 20% of the index. So if one of those screw up and their guidance is weak because of inflation, because of the war in Ukraine, because of everything else that is happening around the world right now, expect another big sell-off. Now you might think, how much of a bigger sell-off can we have? We're already having a big sell-off. Well, if those big guys are slowing down, then rest assured that all the smaller guys are slowing down as well. So let's have a look at all of those big guys on stockkart.io. That's where you can find this channel's portfolio as well. It's free to follow. Link will be down in the description below. And by the way, with the up and coming earnings season, it's very, very useful to use StockCart because you can go here on the earnings calendar up there under tools, and you basically get every company that reports on each and every day. So I've picked out already the big tech companies. You can actually see them right here, Microsoft. And even if you don't want to click through them, you already get the major overview here. Green, 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 yellow. Yellow is neutral, green is good, red is bad. Now let's actually go and look at those cards. So first up is the biggest one, which is Apple. So Apple, high growth potential, strong operations, calm investor sentiment, because basically the stock this year hasn't really moved that much. Same return as the market. In the short term, in the longer term, it has returned much more. Overvalued stock, I would say probably at the metrics that they're giving here, which we're going to see in just a second. And then as for the analyst consensus, 27 buy, 8 hold, 1 sell. Now, as for a PE ratio for a company like Apple, it is high, right? 26.79. It's pretty high. Now, let's look at the overvalued stock. What does that mean? So first up, we have the fair share price. It says here that it's at least 10% lower than the current share price. That's why it gives you here a red X. And then as for the valuation multiples, it looks at the last 12 months price to earnings ratio, price to sales ratio, free cash flow, and price to book. It's a bit overvalued. Now, that does not mean that Apple is not a good company to own, but you might want to consider and look at other companies. Now, what is the market expecting? Well, the market is expecting earnings per share of $1.43, up 2.1% year over year, and revenue of $94.07 billion, up 5% year over year. Now, what will we be looking for is obviously how iPhone and all their other newer products have performed, especially in China with the recent shutdowns, etc. Let's see how that performed, and maybe we'll get some guidance as well. The advertising side of the business, since IDFA is probably booming as well, and then maybe some product announcements along the line. Last quarter, it reported an all-time high revenue record of $123.9 billion, up 11% year over year, and EPS of $2.10. Now moving up to the next one, which is Alphabet Google, one of these companies that there are really zero reasons why you don't want to own this company. And analysts agree because it has here 37 buy ratings, 0 hold, and 0 sell. Fairly priced stock, same return at the market. In the short term, if you look at the 3 months, you see it's a bit down. But if you look at the 5 years, it's up significantly. And obviously, since it's all time, it's up a lot. Now, it has high growth potential. Well, seeing where those markets are, it's normal. Strong operations, calm investor sentiment. And then the average price target is $3,484. Right now, we sit at $2,392. So a quite nice upside, even for a company like Google. Now, for Google, the PE ratio is a bit less than Apple. So there you have it. That's already one other option that you can have. And what is Wall Street expecting this week? So Wall Street expects earnings per share of $25.55. That's actually down 2.8% year over year, and revenue of $67.8 billion, up 22.6% year over year. Now, what should you expect from Google, the various segments? So we obviously need to see continued growth across the board, whether it's search, cloud, YouTube, Waymo, Android, etc. Now, we know that their YouTube side of the business is extremely big. It's as big as Netflix and actually growing faster. So let's see how that performs. Google Cloud, obviously a huge aspect of the business, seeing if there is an accelerated growth there. Overall, you will need to see, again, a performance by such a huge company. And now before I continue with Amazon, Microsoft, and Facebook, I'm not going to name it Meta anymore. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. So with Amazon, it's one I hold in my personal portfolio. You have here high growth potential, strong operation, calm investor sentiment, fairly priced stock, same return as the market. And then with the analysts, almost all of them have a buy rating besides one that has a hold rating. Now, if you look at Amazon, it has been flat, if not red, for the last year or so. Over the last 5 years, it has returned quite nicely. And then obviously, since all time, it has returned incredibly well for these long-term investors. Now, with Amazon, obviously more recently, we had some slowing down of the more mature part of the business. So what is Wall Street expecting? So Wall Street is expecting earnings per share of $8.47. That's actually down from $15.79 in Q1 2021, and revenue of $116.5 billion, up 7.4% year over year. And this is mainly because Amazon is reinvesting a lot in their own business, taking also a hit. Operating income is also down. Well, last quarter it was down as well. We can see here actually, which is something I mentioned before, the advertising services for the company is already bigger than Google YouTube, I believe. And nobody is really talking about that segment here, the advertising side of the business, which is growing quite nicely, right? 32%. So we're going to see how that one performs. And then obviously AWS, we're going to see how that performs as well, also growing quite nicely. And then the more mature parts of the business, let's see what happens there, especially now with inflation, shipping rates, costs, everything going up, the unions, and obviously the war in Ukraine is also going to affect Amazon. Now I'm going to add two things. One is Amazon Web Services being the king in streaming. What do I mean by that? Well, look at this tweet right here. So it says here, Amazon is the landlord of streaming wars. And it's basically the Galileo of streaming, right? We said that Galileo is the AWS of fintech. Well, AWS is the Galileo of streaming because it hosts Prime Video, which makes sense because, well, it's part of the company, Netflix, Hulu, Disney+, HBO Max, Discovery+, Peacock, and many more. Basically, as streaming becomes bigger and bigger and bigger, well, Amazon, whether Prime Video becomes even bigger as well, doesn't really matter because they're going to win from it regardless because of AWS. And then also last week we had this announcement that they're now offering Prime to merchants outside of Amazon, which is basically one of the main reasons why Shopify fell even more last week because, well, if you're an online store, let's say you're creating your store with Wix, which by the way they've partnered up with, you create your online store and now at checkout you offer buy with Prime. Why wouldn't I, if I'm a Prime member, choose that option over all the other options? Just makes sense, right? And also for the merchant, it makes sense to offer that option because, well, Amazon just helps you with everything, fulfillment, shipping, etc. So at the end of the day, big tech always wins. Does that mean I'm bearish on Shopify? No, not at all. Up next, we have Microsoft. I'll go a bit faster over this one because there's not much to talk about. So high growth potential, strong operations, outperform the market, fairly priced stock. When you get all of that, you don't really see a lot of companies that have those three green ones and then still a fairly priced stock. Calm investor sentiment, 33 buy, 1 hold. And this one actually has a higher PE ratio than Apple, 29.18. Now as for Microsoft, what does Wall Street expect? So earnings per share of $2.2, up 12.8% year over year, and revenue of $49.05 billion, up 17.6% year over year. So quite nice growth there. You can expect maybe some comments with regards to the acquisition of Activision, maybe some updates there. Obviously continued growth in cloud, since that's a huge part of the business right now. And then the other various segments of their business, gaming maybe more specifically as well. And now last but not least, Facebook. High growth potential, strong operations, undervalued stock, which is the first one here, and same return as the market. Well, it has been actually a horrible year, to say the least, for Facebook. As you can see here, in 1 year, it's down close to 40% or so, which is very, very surprising because the business has been growing tremendously. It has 32 buy ratings, 12 hold, and 1 sell. Right now, the price is at $184, and the analyst target is at $317. You can expect upgrades and downgrades, obviously, this week after all of these companies have reported. But the upside here is real. Now, what does the market expect? So it expects earnings per share of $2.51, down 23.9% year over year. So quite significantly, and maybe that's why the stock is down so much. And then revenue of $28.24 billion, and that's up 7.9% year over year. So what will I be looking out for with regards to Facebook? Number one, IDFA. Have they seen some improvements on their side with regards to advertising? If yes, how much? Maybe guidance will be much better than expected. Number two is obviously Reels. Reels, TikTok. They know that TikTok is growing and growing extremely fast. Reels has been put there to stop that and maybe help them grow and help monetize Instagram a bit better, even though we know that Reels isn't really monetizable as much as the OG Instagram. So hoping to see some numbers there. And then lastly, obviously Reality Labs, the whole metaverse, VR, AR, Oculus, etc. Some lights on that segment of their business. Are they going to spend even more money? Are they cutting on cost? Also share buybacks, etc. I'll be looking out for all of that this week. So to conclude, huge week for the market, huge week for my portfolio and probably your portfolio as well. This video has been much longer than the usual ones, but hey, we're talking about various big tech companies here, so maybe it deserves a longer video. Again, if you want to follow this channel's portfolio, it's on stockcar.io. It's free to follow, and the platform, as you've seen, is great. You get a lot of information there. And do let me know down in the comments below if any of those companies are in your portfolio. Maybe you're looking to add to some of those. Leave it all down in the comments below. And if you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And as always, guys, take care, stay safe, and see you all in the next video. Bye bye.